Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report. Corey Fleck here, your host for this weekend show. Be sure to check out our website, kereport.com, and podcast The KE Report. You can also find us on YouTube now, posting a selected number of our daily editorials. On this weekend show, I'm going to start off with more macro comments, looking at economic data, looking at the Fed meeting, also looking at the market moves in a broad sense. And then in the second half of this first hour, going to be diving more into resource-specific stocks as I'm chatting with Joe Mazumdar. I am kicking off this show with Marc Chandler, managing partner at Bannockburn Global ForEx, also editor of the Mark to Market website. Now, Mark, it was a busy week. We had a Fed meeting, we had jobs data, we had other news and earnings, key tech earnings that could have driven markets. And initially, they did move markets down to start the week. But by the end of the week, markets came back almost pretty much to neutral on the week. Mark, let's start off with the Fed meeting then. We didn't really hear anything new from Powell other than higher for longer. Rate cuts probably not going to happen at the next meeting in June. What was your takeaway from what Powell had to say this week?
I think you're right. I think that Powell didn't really tell us that much we didn't know. I think that many people thought that he was being dovish when he did not endorse the idea, the speculation of a possibility of a rate hike. But, here's how I sort of see it. First, I'd say that there's like a cottage industry that thrives, that makes a living on being critical of the Fed. But here's what happens. In December of last year, the Federal Reserve says, inflation, CPI, which had risen at an annualized pace of 2% in Q4, the Fed said, despite inflation hitting our target, we're not ready to cut interest rates yet. We're not convinced that we don't have the confidence that this is going to be sustained. They said maybe 3 cuts in 2024. The market, by the middle of January, was pricing in 6 cuts plus. That's not all on the Fed, I don't think. Now, I should say then, the market's corrected. And after the Federal Reserve meeting, the market said, the Fed's dovish. They didn't endorse the possibility of a rate hike. And then 48 hours later, we get a soft U.S. jobs number. And a soft U.S. jobs number, the market has gone from pricing in like a very small chance 2 hikes to practically pricing in the 2 cuts fully. The market, on the eve of the FOMC meeting conclusion, the market was pricing in 28 basis points of cuts this year. And now it's pricing in almost 45. So I think this helps explain, that the jobs data, the Fed has really been the prudent one, it seems to me. And the market, as it happens, as it often does, seems to have exaggerated in both directions.
Let's talk about that jobs data because, look, you can poke holes in all of the economic data, and people do that. They try to find either weakness or strength within any data point, usually to confirm their bias. But looking at the payrolls number for April, it came in below the estimate, missed by almost 70,000 jobs. A couple prior months were revised down by 22,000. It was interesting that most of this miss was due to the government sector because the private sector added almost all of the 175,000 jobs in April. Mark, what did you see within this jobs data?
So I don't think that the jobs data, but I want to make 2 points. One is about how the Federal Reserve is going to see the jobs data, and for them, it's not a game changer for a couple of reasons. One is that there's going to be another report before they meet in June. Secondly, I'd say that I don't think it qualifies for unexpected weakness. It was softer, and a lot of the internals were softer too. I want to say the unemployment rate ticked up, hourly earnings smaller than expected increase. So the other thing that happened was the work week fell by 1/10 of an hour, which really will impact output. And I think that given the general strength of the labor market, the Fed is clear that they're more focused on the other mandate about price stability. So for these reasons, I don't think it was a game changer for the Fed. And for the markets, I think the takeaway, I think, for the markets is that the fear of reacceleration of the economy, the speculation of a rate hike seems to be misplaced. Another, just like I say, an exaggeration. And as you look forward to the next batch of important data, in some ways this year there's only been 2 reports that have really mattered to the market for the most part: jobs data and the CPI. on May 15th, we're going to get the CPI and retail sales. And both of them are likely to be softer. So what I'm thinking is that the at least so far we've seen from the April data that the economy looks like it lost some momentum, but not a sufficient amount of momentum to get people really, I think, concerned about a recession. I just think that it's not accelerating, and that is a good thing. Isn't this what a soft landing would look like?
Oh, that is the question, right? Everyone is still now debating if we have a soft landing, no landing, or if this recession is continuing to kind of sneak up on us. I do want to touch on one more thing that came out of that Fed meeting, and that was the the quantitative tapering plans, where the Treasury drawdowns were expected to be moved to about 30 billion per month from that 60 billion number, but instead they went down to 25 billion. Any significance here on what the Fed is doing in terms of that balance sheet unwind?
I don't know. I suspect not, because remember what they did. They did cut the roll off of treasuries by about 5 billion more than expected. But 5 billion, this is like almost a rounding error. This is just a cap. It doesn't mean that the Fed does that every month. And they also made it clear that they're going to continue to let the agencies at the same pace as well that they were doing before, 35 billion a month. So I generally think that it's not that big of a deal, and I think it's offset by something that happened that very morning of the FOMC meeting conclusion, and that is the U.S. Treasury announced that starting at the end of the month, they're going to have the buyback program. They're going to be buying off the run treasuries, older issues, to try to help boost the liquidity of the new issues. So even though I don't think that really has any fiscal implications, I just think that mentally or from like say emotionally from the market's point of view, that it's probably a wash. That the Federal Reserve is going to be slowing its unwinding at the same time as the Treasury has a buyback. I think the market took it as a dovish sign, and it's interesting what's happened this week. Looking at the 2-year U.S. yield, this is and this might also help explain the other big thing that happened last week, and that, of course, is the BOJ intervention. When the BOJ raised interest rates, Bank of Japan raised interest rates in March by it was roughly 10 basis points. Some people thought the yen should rally on that. In the month of April, the U.S. 2-year yield rose 40 basis points, swamping whatever the Bank of Japan did. So this week we did get a pullback in yields. It's the first pullback in the 2-year yield in 4 weeks. We're down at about 480, having peaked earlier this week a little bit above 5%. This is what we're talking about, I think. The takeaway from my point of view is that the economy has lost some momentum. And what this means is that the interest rate adjustment from those 6 interest rate cuts the market was pricing in the middle of January. I think that pendulum has swung, and with the recent data and the data that I'm suggesting is going to come out later this month, I think the interest rate adjustment is over, and I think that will allow the dollar to basically consolidate, and in the current environment, consolidation means a weaker U.S. dollar.
Let's tie it over, though, to inflation. Quick comment, one more data point, that being inflation. We didn't really get any inflation data this week, but as you said, PCE, that's what the market watches. Overall, inflation has been sticky. Let's call it that. It's not going down at the same rate the Fed wants it to. Fed even admitted that, but it's not accelerating a whole lot higher either. And now we've seen some of the inflation inputs. Again, jobs data, some of the wages filter into that. Oil has moved down off of some of its highs. A lot of different inputs here, but what matters, Mark, in terms of where inflation is going?
So yeah, I think that, in this cycle, even though you're right, the Fed targets the personal consumption expenditure deflator, but we take the CPI, and I think that CPI comes a couple of weeks ahead of it, and that sort of steals the thunder. So I'd say the CPI is still important, and broadly, I mean, I think that you're right. Some of the commodities, oil. Look at coffee and cocoa; those things were flying, and they had a nice setback here too. I don't think that really is the driver of inflation in the U.S. I think that in general, the softening of the labor market will help weigh on on inflation psychology. But generally, I think that we should be expecting some softer inflation data. And Powell said the same thing. He's still looking for shelter costs, which is one of the major sticking points to begin softening, even though he tried to explain how the government's data lags behind what's actually taking place.
All right, Mark, let's get into market moves. And starting with the U.S. dollar. You brought it up a couple of times, but Dollar generally weaker, especially to end this week. It all really started midweek as we turn the calendar over into May. As we're recording this right around 105, but again, it came into May pretty much at 106. So it's been a couple weak days for the dollar. What's causing this weakness? And have we just seen more or less a top being put in the dollar, a little above 106?
Yeah, so I think that, we did see the dollar the euro fell to 106.50 this week. Dollar yen exploded to above 160. And I'd say the two stories, I think, that are helping to explain the dollar's weakness, though it has bounced well off of its lows here today. I think the two stories would be intervention, not just once, but twice in relatively thin markets. It looks like we won't be able to get it confirmed by Japanese data until the end of May. And officials have been very quiet about it. They've failed to confirm or deny it, leaving the strategic ambiguity. But I think that it's pretty much, I think most people now agree that the BOJ intervened, and it looks like they might have sold about 58 to $60 billion. Which is around the size of the intervention back in 2022. This time the intervention took place, looks like purposely, in very thin markets to get more of a bang for the buck. So as the dollar fell against the yen, it helped drag the dollar down against the other major currencies too. This week the only currency that has not risen against the dollar is the Canadian dollar, and that's a bit surprising just given the rally in equity markets. We're up about 1% on the Nasdaq, 1.5% on the Nasdaq this week, and we did get that setback in oil, and we did get a broader setback in the dollar, but the Canadian dollar really traded miserably. Unexpectedly reported a trade deficit instead of a trade surplus. The market expects the Bank of Canada to cut rates as early as next month, which would be, of course, ahead of the Federal Reserve. But when I look at the dollar index, I do think it's rolling over. The 5 and 20-day moving averages, which I like. It's just a nice heuristic device, like a rule of thumb. It tends to catch some big moves, some big trends in the market. I keep an eye on that 5 and 20-day moving average. They're crossing today for the first time since around the middle of March, crossing down. That is a 5-day going below the 20-day. That tells me the trend might have changed. I'm looking at support around the 104, 104.20 area in the coming days. But I do think we've turned. Like I say, this turn should be some consolidation in nature. Remember, in March, after the jobs data, before the jobs data, the dollar index was trading below 102.5. And we've gone not straight up, but we've gone up there, as you know, to about 106.5. So I think we're due for this correction coming on the back of what I anticipate to be softer U.S. interest rates and some weaker economic data.
In all fairness, the dollar's really just been in a range, though, for over a year now, about a year and a half, trading between 107 on the high side and 100 on the low side. Does that change at all here, Mark?
I don't think we're ready for a breakout yet, but even that, you mentioned the 7% range almost. That's big enough for a lot of short-term, medium-term traders. Get that right. You think you think what the alternatives are. So I do agree with you. Broadly range trading, but the range is wide enough that you can still play that range, buying at the lows, selling at the highs, as opposed to a trending market.
Yeah, well, it seems to be trading sideways within that range, but it did come close to breaking out to the upside. Now it's rolling back over. Let's also talk about China. They were on holiday at the tail end of the week. Some people were pointing to commodity weakness as that could have been why. But China's also been doing a bit better economically, and their markets have been doing well. So, Mark, what are you seeing in terms of China's influence in the markets, in the commodities?
Yeah, so I don't know what to make out of, in the commodities themselves. I don't think, for example, the decline in oil has much to do with what China's doing, with China being on holiday. Their May Day, Labor Day holiday began on May 1st, so they've been gone. They've been closed since Tuesday. And what I'm watching is the Chinese currency, and this is why I think some of this talk about China replacing the dollar, it doesn't make much sense to me. The currency is not convertible. So because China mainland's been on holiday, the RMB hasn't traded. But what has traded is the offshore RMB. And the offshore RMB has strengthened by about 1% this week. It is the best week for the year, best week since last November. And before China went on vacation and took this holiday, the stock market began rallying. Now, the Hong Kong stock index, Hang Seng, and there's an index of mainland stocks that trade in Hong Kong, a separate index. The Hang Seng is up for 9 days in a row. And that index of mainland shares is up 8 out of 9 days. And so this is how I sort of think about it. One of the demands for gold has been coming from Chinese retail investors who have been scared by their stock market, scared by their property market, scared by the weakness of the RMB. And so, under the conditions of capital controls, they bought gold. Makes sense. It's rational. It's reasonable. And so, even though I don't know any Chinese person myself who bought gold, it seems like reasonable, and it seems to be consistent with the prices of Chinese mainland gold. And what's happened since then? When China comes back, when retail investors come back on Monday from their holiday, they see the RMB is stronger. They see a stronger stock market. I think that helps induce them. I should say it helps reduce the urgency to buy more gold. So it wouldn't surprise me if we're in a relatively peculiar environment where we get a weaker U.S. dollar and weaker gold prices, as the urgency to buy gold from countries like China or even in Japan, where Japanese investors might have wanted gold as a safe haven, given what was happening to the yen. Remember, the yen was trading like, I want to say, lowest level since 1990. And so because of the BOJ's intervention, because of what we've seen happen to the offshore RMB and the Chinese stock market in Hong Kong, I think that we could see more pressure, downside pressure on gold next week, even if U.S. interest rates soften and the dollar weakens.
Interesting. So very much that Eastern demand narrative, which in all fairness has been very strong out of the East. Who knows? Maybe they'll come back from vacation and continue to buy gold. But hey, you just outlined a scenario there that we don't usually see, where lower rates, lower dollar, and lower gold. However, some of those correlations, at least recently, just really haven't been relevant, as gold and the dollar have been moving higher along with rates. What about copper too? Can I get your comments on copper and the big picture of U.S. economy? Still seems to be chugging along, however, a little bit slower. China, their economy might be doing a little bit better. That could also support copper, but copper made a huge run ever since March and has pulled back a little bit, but really not that much in the big picture. What's your outlook on copper and what's driving that market?
Yeah, I think I'd say China probably still the culprit. They're trying to rationalize production, and rationalize production means reducing the excess production. So I know the idea in the back of my mind is that businesses want to maximize production. No, they want to maximize profit. And sometimes that happens with reducing production. And sometimes to reduce production. That's part of the thing in the U.S. press now. And after Treasury Secretary Yellen visited China and chastised them for their excess investment, their overproduction. And to rationalize that is to reduce the production. How is the U.S. be able to do it? Oligopolies. And China is a little bit further behind the curve in that. And so as they try to rationalize production, cutting production, same time we've had some problems at other mines like in Peru. And so copper is up for 5 weeks in a row. And in this span, it's gone up, I'd say, ballpark about 12-13%. We did get a pullback in the second half of this week, but it looks to me like it's just a corrective pullback, and we should look for another bounce, a new high, and that would put the May copper above the high we saw this week, which was about almost 470. And I think that when China comes back, and this ties into what we were talking about before with the currency, is that part of the reason that China hasn't taken more stimulative measures, especially using monetary policy, could be because the RMB was so weak. It was sort of probing the lower end of its band. If the pressure is off the RMB, this might leave scope for greater measures from the PBOC and Chinese monetary authorities before July's meeting, where they'll get more, where the third plenum, should be addressing economic reforms.
So, Mark, taking a step back then, general assessment of the market environment when it comes to investors. We continue to see data in terms of investors leaning on the bullish side, but some of that over-exuberance has come off the table. How do you see these markets broadly setting up? Are we in a bull market? Are we in a bear market? Where are we going?
I mean, I think that we can get higher in stock market. I think that in some ways, this is what the soft landing looks like. Sometimes we don't know, it's like hard to see it when we're in it, but this, I think, is in this short phase, what a soft landing looks like. I think it's good for stocks. I'm looking for the dollar to pull back. I'm looking for softer interest rates. But generally, I think as I'm afraid this is as good as it's going to get. And so, what does this mean? I think we're going to wind down the U.S. earnings season. And I think that we can have a relatively quiet May, and then it's really, I think, in June where we get some maybe the ECB cuts rates, maybe the Bank of Canada cuts rates, but at least for May, with the possibility of Sweden cutting interest rates next week, I think we're in generally a quiet phase now as the market just sort of digests the data set we have, and I don't think there's going to be, barring a new surprise, I think this is what we have to work with.
All right, Mark, we'll wrap it up here. Thank you, as always, for your time. I always find it interesting to hear what data you're watching and how you're viewing that data globally, too, because it's not just a U.S. picture. And May could be a bit of a slower month here. Who knows? But it has been a very interesting start to this year, especially the second quarter where we started to see a bit of a rollover in markets, but that weakness being bought back after only about 3 weeks of trading. So, Mark, I'll follow up with you next week, as we usually do on Friday. Thank you for joining us on this weekend show. I hope you have a great rest of your weekend.
Good luck to everybody.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, now focusing on the resource sector as I am chatting with Joe Mazumdar, editor of Exploration Insights, a newsletter that I highly recommend for all the active resource investors looking at individual companies, because Joe visits a lot of projects and he takes a critical look at a lot of these companies to share with his subscribers. But I do think a lot of you know about Exploration Insights. Joe, we've got a number of different topics that we're going to get to here, being M&A, the financing environment. I even also want to ask about silver stocks. We might even get into some geopolitics, too, when it comes to different countries that have your attention. Let's start off with the M&A aspect, because, boy, oh boy, we've seen a lot more action in M&A broadly. It's been a lot focused on these more advanced companies, ones that are either in development, close to being in development, or some that are even very close to reaching production. There's a bunch of individual M&A deals that we can talk about, but broadly, Joe, what's caught your eye? What's been the theme that you've seen when it's come to M&A in the metals sector?
Well, thanks, Corey. With respect to M&A, some of the ones what we've been seeing is M&A into Ecuador, mostly with a Chinese bent, like with Solaris taking, potentially a bit of Solaris with Zijin. And then you've got the Silver Corp, which has got a bit of a Chinese bent, but it's not state-owned, acquiring Adventus, which has got a copper-rich VMS project that's been sitting there for a few years, also in Ecuador. And then, in Namibia, we've seen another Chinese company, I think it's Yintai, with its acquisition of Asino, a advanced gold project with a feasibility study there, good jurisdiction. But now the issue is for a lot of these companies, except for the Silvercore Adventus one, I would guess, because that's TSX listed, is whether the BC or the Canadian government approves these transactions, because they're state-owned entities of China that are acquiring them. On another positive, I would say, is Reunion Gold and G Mining in Guyana. So you got a development project with a high-grade open pitable deposit that's getting acquired by a development company that's almost commercial in Brazil. And the combination of that might make for the future M&A target going forward. And then, overarching that is a big potential M&A transaction with Anglo American and BHP. So all this sort of stuff is obviously very attractive for people thinking about the metal or the mineral industry, because now they're seeing industry wake up and actually acquire assets.
Yeah, look, M&A, I think, is good for the sector, for any sector, when you do start to see money getting freed up, when you do see companies combining to become bigger, and something like that G Mining more or less merger with Reunion Gold, those stocks have been doing very well. So it's solidifying some gains for investors. But a lot of these other M&A deals, look, we need to face it. They are coming as stock prices are well off of their highs, and now they're going to be locking in shareholders, most likely to some losses here. Joe, how do you balance it out where there are a couple great M&A deals that no one can argue with because they're happening at highs for companies, but the vast majority of these are coming where stock prices are well off of their highs?
Well, some of the M&A transactions I've been seeing have made perfect sense, like your Alamos and your Argonaut, trying to leverage off of the assets that make sense with Argonaut, and the ones that don't, like the Mexican stuff, trying to get some synergies there with the plant, with their deposit, with the Island Gold Mine, which is underground. I mean, those sort of transactions make a lot of sense because you're not selling down the person that's acquiring, because it makes synergistic sense. And so those sort of transactions I've been seeing, and I think they make perfect sense. The Adventus one with Silver Corp is sort of probably for the investors in Adventus. They might be flat, and this creates a liquidity event for them, and they can move on, but they probably end up with Silvercore shares, and see how that goes. It's for them, it's probably not hugely accretive. The ones that give me more pause that, hey, there might be something good happening here, is more your Reunion and your G Mining, your Alamos and your Argonaut transactions for me that make a lot of sense.
Now, those ones also can move the needle for those companies. So when you're looking at maybe taking positions, do these kind of deals get you into stocks, or do you wait to see how the merger or the M&A all plays out before you actually might take a position?
So one that I'm sort of watching, a couple of ones that I'm watching on that from an M&A perspective would be the other, let's say, major open pit amenable deposit that's in a good jurisdiction would be the Ikkari deposit. That's the gold deposit that is operated by Rupert Resources. They put out a scoping study. They want to put out a PFS, but that PFS would do a lot better. The mine plan would do a lot better if they could have a layback onto ground that's in a joint venture with B2Gold and Orion. I own shares of Orion. That also gives them more flexibility with respect to where they would put their tailings or other facilities. It gives them some exploration upside as well, and a bigger property package. So Rupert had basically bid on the 70% that's owned by B2 for 130 million Canadian, which is locked in. And now the idea is, well, how much is that 30% worth to Rupert? I don't think Rupert wants to put out another technical report until they get the layback, because for them to eventually be acquired, I think that layback and the flexibility of having more space to put facilities means a lot. And so that's definitely one that I'm involved in from the Orion standpoint. But the merged company, whatever happens, I think just like G Mining potentially would be acquired by a bigger company. So that one I definitely am watching. The other one that I'm watching, I was just down in Las Vegas, checking out the Silicon Merlin project again. And, they've got a lot of drilling there, and that Merlin project is now where the gravity of that 13 plus million ounce resource that Anglo Gold have. And so for me, the M&A opportunity is probably with Origin royalties on their 1% NSR that they have on that deposit, which keeps growing. And so those are the M&As I'm really watching right now in terms of my own portfolio.
Now, I know that every deal is different, but when you're looking at M&A, we have seen a mix of companies, as you just said, consolidating different areas. One that you can see has synergies between projects. We've also seen other M&A deals where companies are diversifying into different jurisdictions, usually safer or so-called safer jurisdictions. How do you analyze the difference between these two? Which ones do you like better?
Well, I think that diversification is important, especially if you're in a jurisdiction that's hated and you don't get much of a valuation for what you have. And so you're constantly looking for another jurisdiction where you could diversify if you're a producer, your free cash flow, such that you don't get discounted so much. So those sort of make sense. And then you're taking your comparative advantage of, knowing how to operate and that. But geopolitical risk is getting a lot, I don't know, it's very fluid now. Like how fast and furious that Mexico has gone down with respect to an investable region, and just now is basically a pariah for exploration. And now, we're seeing BC go down a similar path that we don't know what's going on in BC, and probably a lot of companies will have trouble getting new ground in BC right now until they resolve what the new Tenure Act looks like. So when I was down in South America more than a week ago, I popped over from a trip looking at a rare earth project in Brazil and Chile to Mendoza, which as a province was not a good place to do any kind of mining or exploration. Big agriculture industry with the wine, tourism, and all that. But the government and a lot of these industry people are seeing how well another province next door, San Juan, is doing, and they want to do as well. And they think that they probably have an equal amount of geological endowment, but nobody wants to use cyanide, and nobody wants to use these acid like sulfuric acid to leach copper. And so what they've tried to do is generate polygons of areas that they can have social license to operate. So they're doing that in advance of the company coming in. So now the company doesn't have to come in and have 20 people there for 2 years trying to gain the social license to operate. The government's actually done it for them. And so could be attractive for coming into that jurisdiction with a good mineral endowment and not having that issue about trying to wait for social license to operate. It's already there, and now you're just permitting your program, whatever that is. And the government's very helpful, but it's within an area that the people there do want mining.
All right, Joe, let's switch focus a little bit to the financing environment, almost going down the food chain here, because some of these M&A transactions have happened because companies are running out of money. Others have happened because some companies, some medium-sized producers are doing very well and they're getting larger through M&A. There's a lot of companies, though, that need to raise money because of just how tough the last about 3 to 4 years have been. We've seen a lot of financing deals announced, some close, some are dragging on a little bit. How do you view the financing environment right now?
A terrible, probably. I mean, even though, it's like that Doors song, I've been down so long, it looks up to me. That's basically where we're at. And because the financing people announced bought deals and it's oversubscribed, but it's almost like the company has bent over for the financing, and they're offering a big discount, but it's still a long-term half warrant. So the financing actual transaction is more appealing than the company right now. And so we're seeing deals happen, but given the movement in gold, given the movement in some other commodities, we're not seeing that filter through to better financing transactions. I'm not seeing that. I definitely do see the M&A, like especially in the copper, because people are seeing that, and I think that's a good indicator that copper prices are just going to go higher. So for me, that's positive, and you should own a copper producer. That's definitely what you should be doing. But whether you should be owning a gold producer, that's another thing. And so I've sort of stuck with the royalty companies, the cash flowing royalty companies, the juniors, to get exposure to precious metals more so than going to producers. But definitely with copper, I do own a copper producer.
But Joe, when you see companies either that you hold or that you just simply see are financing, even though it's coming at a discount, even though they're issuing a warrant, if they can close that financing, if it gives them some money to do some work this year, does it make it more interesting to you?
Well, the problem that I have is what I've been trying to scale down is exploration projects and companies that are exploring in remote areas where the bang for buck in a difficult environment financing environment isn't very high. And so, as opposed to getting that 5,000 plus meter drill program, they can only do 1,500 meters. And so to get a significant program, they have to dilute even more, as opposed to somebody else in a different jurisdiction that might be able to do better, like in Australia or somewhere where they're doing $250 Australian per meter, as opposed to $450 US per meter in some other places. So that's something I'm very conscious of, and then access to capital, like now, so more than ever, you do need those investors with deep pockets, whether it be an industry, a joint venture with a big company, or, a big group that is, well known in the industry that people will follow, but also will always fund that project. Those sort of things are also definitely, I want that sort of box checked as well.
Hey, you mentioned that you're looking at cash flowing royalty companies. There's quite a few of them right now. The big boys that have been around for a while, well, we all know them, but there's a lot of these smaller royalty companies that are generating cash. It's not huge amounts of cash, but at least they are generating some high margin cash. And the forecasts going years and years out look promising as more mines come online. But how do you isolate? How do you figure out which one of these, let's call them smaller royalty companies, are better than the rest?
Okay, so Origin is a top pick. It's been a top pick for over a year in the Exploration Insights portfolio. And the reason for that was the Ermitaño mine, where they have a royalty. I think it's 1.5% NSR. It's operated by First Majestic. It's in Mexico. So they do have that exposure to Mexico, but it's an operating mine. It's not exploration. And they're getting cash out of it, and they're growing their treasury, and so they don't have to go back to the market to fund anything, like whether it's their prospect generation activities, which actually makes the money. And then underlying that is that option on that deposit I was talking about, the Silicon Merlin deposit, which at 13 to 14 million ounces might be one of the biggest gold deposits discovered, basically blind, in a known area, district that people have walked over probably for the last decade or two. I don't know of a big major deposit like that, plus 10 million that has been discovered. And they have exposure to it. So they can just sit on that while Anglo Gold does all the work with respect to drilling it, with respect to announcing it, with respect to doing the technical reports, and they're reaping the benefits of that. And all the other work that they're doing is being funded by their other royalty. And so in terms of financing risk, it's very low, but it's also got the optionality to upside. So those are the sort of unicorns you're trying to look for.
So it really sounds like you're sticking with the royalty companies that have a couple, not tons, but a couple flagship royalties there that already are paying or at least have near-term path to pay money and have long mine lives. Are you avoiding some of those companies that are getting small royalties from a lot of different mines then?
Well, the thing is about this one, and then, talking about M&A in the space, because as you pointed out, there's a lot of royalty companies out there. So the demand is there for royalties. The supply of good royalties is low. And so what's a good royalty? A good royalty is like plus 1%, but also on a major asset, long lived, in the hands of potentially the company that will build it in a good jurisdiction, as you could point to Franco-Nevada and the Panama incident with Coca Panama. So if you combine that, you don't need that thing to be near-term cash flowing for it to be worth something to a major royalty company, because there's not a lot of potentially 10 to 20 year assets that, they produce this fundamental, a mine plan, Anglo Gold on the Merlin, just on the Merlin. And there was like on average, the first 3 or 4 years, they're producing over 1 million ounces. I mean, this is their forecast. This is not nothing to do with Origin. And how many deposits like that are there? And so if you have a royalty on that, that makes your royalty worth all that much more because it's so unique. Being in Nevada, being held by a major, having such a big endowment, and potentially with more growth opportunities. But you're not raising money to keep that option alive with respect to royalty. You don't need to sell that royalty to pay for your G&A. Your G&A is already being covered by a smaller royalty because you've maintained your G&A. Your prospecting business pays for itself. And so you've managed your business such that you don't need to return to the financing market. And that's how your share price can appreciate, because usually when you do something good, people are just waiting for you to come to the market to finance. But when you don't need to, they'll have to buy it in the market. And that's how your share price goes up.
Makes perfect sense. But you know what? The royalty companies, they are a superior business model, which is, I think, why we've seen so many more pop up. But there's just so many of these small royalty companies, all with different positive selling features. But I like what you're saying, though. Stick to kind of those royalty companies that have some of these major royalties that could even be attractive to larger companies. I also want to ask you about silver stocks. I know from a couple investors that I talk to is that they're looking more at these silver producers that, in all fairness, weren't really making money over the last couple of years, even with silver in the low 20s. Now that silver made around to $30, these guys are thinking, hey, if these companies become profitable, they won't need to keep coming back to the market. They could be revalued. How are you viewing silver stocks? What stands out to you?
Well, I mean, the thing about silver is that just like copper or any, silver is more industrial than gold. And so it's worth looking at the supply issue with silver. And if you look at Mexico and, their ban almost, open pit mining, the fact that the Morena party has got a high probability of coming in and maintaining power. So AMLO's influence might extend. So a lot of these silver projects that are open pits, might not get developed in Mexico. Peru, probably better than Mexico with respect to jurisdiction, but still permitting has not been good in Peru. And so, where do you go for silver exposure? And those are the two of the biggest silver, pure silver plays. I'm not talking about the big base metal mines that produce the majority of silver. So other jurisdictions come up, like Argentina and some other places that, could potentially have decent silver deposits. And so that's basically where I'm looking.
Now, what about the silver producers, though? Do the higher prices attract you at all? Should they attract investors for these mines that are already built, but we're losing money for years?
No. So for me, no. So I will stick to the royalty companies and the junior ones to get that precious metal exposure, from gold and silver. So in terms of, hey, the gold price has gone up, how do I lever myself to that? I'll stick to the royalty companies over the risk of margin compression on a producer. I'm not doing that for copper. Copper, I am taking on that leverage. I will buy producer in copper. I just not doing that with the gold companies.
So what about the silver stocks that you're looking at, maybe in Argentina, any that you care to share with us that you like right now? You like the setup?
Yeah, so there's this project that I've known about and driven past in the 90s when I worked in Argentina called Diablillos. It was drilled by Barrick. They probably did more than 30,000 meters during that time. And they were looking at one particular part of this project called Oculto. They put together a resource. Metallurgy was always an issue, but back then, gold was whatever, $300 an ounce. And silver price was much lower. And they couldn't make it work as a heap leach. Fast forward, there's been a little bit of work done on that project off and on for 2 decades plus, and now AbraSilver has taken it over. They've expanded the resource. They've found more mineralization with the Jack deposit. There's more targets there, so there's a lot of exploration upside, and they've improved the metallurgy. Now it is more milling, getting that grind and then increasing the recovery. And so, they can get 80 plus silver and gold. And what's interesting about it is that, Kinross, for a small amount of capital, 10 million has come into that project, as well as a Argentine power producer, because these guys are looking to do solar there. And what's interesting about Kinross is they're not in Argentina normally, and but they do have the La Coipa deposit in Chile, and apparently the metallurgy and the type of deposit, high sulfidation epithermal, is very similar between the two. And so that investment by Kinross, modest as it is, gives that company, between the two investors, $20 million to explore more and get to their feasibility study. They just released a PFS, which should be out this week. And so those are the sort of things I'm interested in: a viable open pit project, but in a jurisdiction that doesn't mind open pits.
To your point about that La Copita project too, that is actually under a tech option to acquire 80% too. So the company has a couple large players in this stock. It's a stock we've had on the show a number of times, and hey, they've done some good work here, and it sounds like they still have a lot of exploration that they can do to grow those assets. Final comment then, Joe, I know that you were just in Argentina. We've had a change in government in Argentina. I've heard a lot more positive comments. Is this becoming a stronger focus for you?
Oh, absolutely. So I went down to Mendoza to talk to the government there, but the problem has not been attracting foreign direct investment into Argentina. Because the lithium has worked there for a while, mostly, let's say, Chinese investment, but a lot of people have made money on the TSX and that, with lithium plays being bought out there. And that's happened in Salta and Jujuy. Obviously Santa Cruz have had a lot of gold and silver success. San Juan, your Filo, your Vicuña district sort of stuff, and it's had operating mines prior. And so that's all been elevated because of the new president. And suddenly, the issues with, exporting, the issues with holding how much cash you can hold, and taking money